On the line this morning, I'm fortunate to have my guest. He's William Exeter, goes by Bill on the friendly basis. And Bill is with the Exeter Group, and he's also, and one of the companies that is associated with that is Exeter 1031 Services. And he's been doing the 1031 exchanges for over 34 years. So we're delighted to have him. Bill, welcome to the program.
Thank you. Thank you for having us. Pleasure to be here.
Bill, if you could give myself and the listeners a little bit more about your background, I gave just kind of really just a snapshot there. I'm sure with 34 years of experience, you could tell a little bit more about yourself, and if you would, that'd be great.
Sure. In fact, it's funny. You never go to college and think, I'm going to grow up and be a QI. It just kind of happens. But I was controller of a bank back in early 80s, and they decided to start a 1031 exchange company, and I had no idea what that was. The outside counsel said, don't have your escrow subsidiary run that. We think there's an agency problem. So they threw it at me. And coincidentally, a couple months later, UCLA had a cooperative extension program on 1031 exchanges. So that was 35 years ago. And the rest is history. So I actually now teach the same 1031 exchange program for UCLA. So we've kind of gone a full 360 there.
Oh, really? So you were in the first class, and now you're teaching the class? Is that?
Yep.
Well, that's great.
It's kind of funny how life works.
Yeah.
So for the most part, I started the QI for the bank there. Had my own QI for a short stint after that, and then realized, if you really want to do large transactions and more complicated transactions, at least at that point, decided it was time to join a larger company. So I ended up with Chicago Title and ran their 1031 exchange and trust company on the West Coast. And then, they ended up selling off pieces of the company to different other enterprises. So that kind of changed our whole career path there. Ended up ultimately starting the Exeter Group 12 years ago now. So we've been doing it for 34 years. This particular company has been doing it for 12 years. And we've kind of set ourselves apart in terms of qualified intermediary services as being more advisory and consultative rather than just a processor.
Got it. And I think I just decoded the QI, qualified intermediary. Is that what that?
Yes, I probably should have explained that.
I was going to ask you, and I thought, because I was thought exchange. There's an X in there. I don't see here. Maybe the Q is silent, but got it. So that's probably a great place to kind of start. And if we could talk, I think just at the very beginning, what is an exchange? And maybe let's back up one second, because I think the qualified intermediary is a critical component to this whole thing. Maybe we start there and then build from there. Does that sound good?
Sure, absolutely. So the key is at the close of your sale transaction, you don't want to have the right to receive the funds, or what they call a constructive receipt or actual receipt of the funds. So the qualified intermediary actually is designed to prevent access to the funds. So the key is having a qualified intermediary in place prior to close of escrow. We get calls every week, literally, from somebody who said, I closed on my sale transaction a couple days ago or last week, and someone just said I should look at a 1031 exchange. And at that point, it's too late. The 1031 exchange has to be set up prior to the close. The qualified intermediary needs to draft all their legal documents and get them signed off before close. Otherwise, there's no way to go back and fix that.
Got it. And is the qualified intermediary, do they receive the proceeds and hold in trust, or what's the mechanics of that? If I've got a property that's I'm selling, and I reach out to you and I say, hey, Bill, I'd like to do a 1031 exchange.
A good question. So the first step is we draft the documents. That creates an assignment, if you will. So the purchase and sale agreement is assigned to the qualified intermediary. So in layman's terms, that really means that we step into the seller's shoes and become the seller for tax purposes. At the closing, then, we're the seller. Transaction closes. The funds are wired to us as the qualified intermediary. Those funds are deposited into either a qualified trust account or a qualified escrow account. Depends on the qualified intermediary you're working with. There should be a qualified trust or qualified escrow account involved. And that's what prevents the taxable event, and that's what also starts your 45-day period and your 180-day period. And then, in addition to that, from our perspective, we think one of the most important parts is to be available, answer questions, work with the client and their advisors, and providing guidance on how to structure transactions and making sure that they're in compliance with the tax codes.
Got it. You mentioned timeline as far as not the 45 or the 180. We'll talk about that in a second, but I wanted to ask you more about the setup. So if I'm intending to do a 1031 exchange and I'm not yet at closing, how much time should I allow for getting it set up to where you can become the qualified intermediary?
Good question. Probably the ideal time is you go under contract. You probably have a 1 to 2 week period when you're going through your contingencies. And I would say once those are signed off, so you're pretty sure it's a solid transaction, that's a good time to get the exchange set up and in place. The absolute requirement is that it has to be in place before closing. In our case, if it's a regular 1031 exchange, we offer same-day service. So we've actually had people call and say, I'm at the closing table right now, and I need to set up a 1031 exchange, so you kind of drop everything to get it done, which is possible, but it frustrates everybody. So probably about 2 weeks in is the best time to do it, so that way everyone has time to get it set up and it doesn't stress the closer out.
Got it. Question for you on kind of the sequential order of things. I think the way that I've understood this in its simplest forms is that you sell the property that you intend to receive a gain from, and then you go out into the marketplace and then find a suitable replacement property. I was listening to something or talking to somebody, and it was kind of they were suggesting their sequence of order is find the property you want first, and then get to selling your property. And is there a right, wrong? Is there a method to the madness? I mean, if you have the qualified intermediary set up, that relationship set up, is there kind of a dance that goes on to do that, or can you speak to that?
Sure. Certainly you want to get the qualified intermediary set up, but there are different ways to plan, and that's probably the key word is to plan. I think a lot of clients probably just dive into it and it kind of happens and unfolds, and it can be pretty stressful. But if they can go out and find their replacement property and have that locked up somehow, and then close both concurrently or close on the sale and then close on the replacement property fairly close, that takes a lot of the risk out of the transaction. So you could sort of go out and look for whatever property is suitable to replace it with. You could tie that up with an option, a lease option, something like that. So you've got control over the property, and then you can decide when you're going to exercise the option and close on it. And that would eliminate some of the risk. For those who just, go into the exchange, sell the relinquished property, and then start looking, they've triggered their gain. And the question is, can they identify a replacement property and then close on it? And if they can't, then it's a failed exchange and it becomes taxable. So that's really the risk. So I think whoever you were talking to said, go out and find your replacement property first is probably really good at planning, and that's really what they should do. The other option is to go out and find the property you want and then do a reverse exchange where you can close on your purchase first, and then you have 180 days to sell your current property. Those can take a lot of the risk out of the 1031 process because you're actually closing on your replacement property first, but they're more complicated and more expensive as well.
I'm glad you brought that up because it's been years since I've even heard the word. By day, I'm an insurance broker, and a client of mine, a real estate client of mine, they purchased a property, and it was in a reverse exchange. And if you could speak to the mechanics of that a little bit, because I think, well, I'll let you if you don't mind, speak to it, and then I'll ask you some questions if I have.
Sure. So the reverse exchange allows you to buy first, sell second. There's a couple of different ways to structure the reverse exchange. So we have to kind of discuss that with the client, find out how they're going to pay for it. That's probably the first issue is the relinquished property has not closed yet, so your equity is trapped. So if you're buying your replacement property first, how do you pay for that? Is it financing? Do you have other cash? Certainly, if you have enough cash to pay all cash for the replacement property, the reverse is much easier to set up. If there's going to be financing involved, lenders are not terribly excited about reverse exchanges because we have to hold title. It's what the IRS calls parking title. So if we're taking title to the replacement property and that's the property that'll be used as collateral for the loan, the lender's probably not going to allow that. There is a way for us to do it a little differently where we take title to the property they're selling, but we have to make sure that the cash numbers work out okay, et cetera. So that's probably a little too detailed, but it certainly allows them to go out, find the property, take all the time they want. There's no deadlines, put it under contract, go through the closing process, and then we take title to that property or park title, and then they have 180 days to sell their current property. So it eliminates a lot of the risk of the 1031 exchange because you don't have to worry about, will I find it and can I close on it because you already have.
Got it. But the timeline, the 180 days to complete the sale of your property with the equity, that clock starts as soon as you close on the I guess your new property. Is that right?
That's exactly right. Yeah. So
Okay.
as soon as the purchase closes, you've got your 45 days to identify what you're going to sell. Most people know that, so it's just a formality, and then 180 days to complete the sale.
Got it. And then, if I did hear you right, so you, until the exchange is completed, you do take title to the new property, and then that, I assume, allows for the clean transfer from the old property equity to the new property, or is that what occurs? Is that what we're trying to accomplish there with that by you taking title to that?
Yeah, effectively, I mean, a true or pure reverse exchange would allow the client to go out and buy and take title to the new property, and then they'd own both properties at the same time. And that's not permitted. The IRS hasn't ruled on that, and we don't have any guidance on that. So it does not qualify. So the IRS has actually set up this parking mechanism where we go out and hold legal title, and it gives the client 6 months to then market and sell and close on the sale of their current property.
Got it. And when that occurs, you mentioned the banks are not exactly real excited about that. Is there if one doesn't have cash, is there like a short-term hard money lender kind of thing? Or have you seen various? Can you give some examples of reverse exchanges you've seen work?
Yeah, in fact, probably the most common would be hard money, private money. Some of your local community banks that are portfolio lenders where they make the loan and keep the loan in their portfolio might consider that. Any traditional lender, most mortgage brokers are just going to make traditional financing, traditional lending available. They're not going to touch this. If you walk into any of your typical big banks, they're not going to touch it because they really are going to make the loan, package it, and sell it off to investors. And they're concerned that if we're holding title, it may not be a sellable loan. So it's really going to be hard money, private money, or any portfolio lender that they would look at. Or we're going to take a look at the other strategy where we take title to the property they're selling. That gets even more complicated, and we have to make sure that the client's in a position to advance at least enough cash to cover what their expected equity is. And that's usually a big number, so it's hard to come up with that kind of cash.
Right, right. And let's go into kind of just a traditional exchange for a moment. You're the qualified intermediary. We've reached out to you. We've had the conversation prior to closing. You've drafted the documents. You're ready to receive the proceeds from that. Let's talk about the clock, the mechanism or the timelines that are that govern the 1031 exchange.
Okay. The closing of the sale is what triggers all the deadlines. So if your relinquished property closes, let's say today, tomorrow's day number 1, and you've got 45 calendar days to actually identify what you're going to acquire, and there's different identification rules to look at. It also triggers the 180-day exchange period. So you've got 45 days to identify, an additional 135 days to complete the 1031 exchange for a total of 180 days. So it's not 45 plus 180. The 180 days includes the 45-day identification period.
Gotcha. That's important to note. It'd be a mess if you thought you'd done it all right and found out you're 30 or 45 days past your deadline because you weren't using the same clock.
It would be a little surprise.
Yeah. And so, and essentially what one's able to do then is to not pay the gain from the tax code allows this exchange so that the gain you recognize from the sale of the investment property can be transferred to the new property without paying tax on that income tax or capital gains tax on that gain. Is that kind of the sum of what the whole purpose
Absolutely.
is? Okay.
And at federal level, you've got capital gain taxes, depreciation recapture taxes, and you have the Medicare surcharge, the Obamacare tax that a lot of people forget about. And then you have, of course, your state tax. So it depends on what state you're located in. Except for the state of Pennsylvania, all of the states mimic that as well. So you can defer your federal and your state taxes. And that's really what it's designed to do, is defer the taxes, keep all the money in your pocket as the investor so you can build your wealth faster. If you just outright sold, you're going to lose about 30% plus or minus of your profit. That's a big chunk of cash to lose.
Yeah. Now, I was talking with somebody else about that. It's been a little while, but I mean, when you start to run the numbers and you realize how much of your leverage, I mean, at 30%, that's a huge chunk to give away, especially if you're trying to build some wealth. Whereas the 1031 now allows you to continue to multiply that number into a bigger number, into a bigger property, and more better things.
A lot of taxpayers assume that they're in a lower tax bracket, and don't forget when they sell the real estate, they're going to have that gain. That gain is going to push them into a much higher tax bracket. So that's really the key there.
Right. And you mentioned federal versus state. Is the 1031? Is it recognized at both state and federal level, or is it?
It's certainly a federal tax code, and then all the states, for the most part, follow that, except for Pennsylvania. So Pennsylvania, if you're selling Pennsylvania property and going to do a 1031 exchange, you would defer federal, but you're going to pay state tax. The other 49 states would allow you to defer all of their taxes as well. There's some nuances from state to state, but for the most part, they follow the code. So the important thing is, talk to your accountant first to make sure that whatever state you're located in, you're going to be in compliance.
Got it. Let me ask you, let's talk about, so we know that we're getting in touch with you a couple weeks out. What could one expect to pay for an exchange? Is it a flat rate for your services, or is it a percentage based of the sale price? Can you speak to that a little bit?
Sure. I think most of the larger, we're a mid-size, so mid-size, larger qualified intermediaries, and for the most part, even the smaller ones, all fall in about the same range. So on the West Coast, you're probably going to see fees from, say, $700 to maybe up to $1,200. That's a little on the high side. The further east you go, you might see them as high as maybe $1,800, $2,000-ish. There's less competition on the East Coast. I was talking to a lady last night who's on the East Coast. She was quoted $3,000, which is ridiculous for a regular forward exchange. Unless there's some complexities to it, it should be much less. So most of us are really going to fall in about the $700 to $900 range. For us, if it's a regular forward exchange, selling first, buying second, and it's one sale and one purchase, it's a flat fee of $799, which covers everything. We don't charge wire transfer fees or anything like that. It's all inclusive.
Well, that's useful to know. I think that again, when you don't know, you might assume that some sort of a huge fee that might wipe out your gain, or the secret handshake after the fact, after you've done it, type thing. But for $700, or even the high end of $1,200, that's certainly a cost that one would want to bear to protect the gain, as opposed to having pay all that. Um, is there, you mentioned West Coast versus East Coast. Is there any challenge if someone was selling a property in one state and going to another state to buy another property?
All states qualify, so they could certainly sell in one and buy in another state. That does not hurt the 1031 exchange. It's done all the time. You and I are in California, so we see a lot of clients who sell in California, which is a highly appreciated market at this point. And they'll often exchange out of state to a location where they can get better valuations, better cash flow, et cetera. The one thing I can say for those who are listening from California is that California has what we refer to as the California clawback. They've always taken the position if you sell California real estate, you 1031 exchange out of California into another state, that it's still tax deferred because you've structured the 1031 exchange. But if you ever cash out in the future, they want their fair share, as they call it. So in California, never really had a mechanism for tracking this until 2013. So now they actually track it every year. The investor has to file an information return with California. Even if they completely get out of the state, they move out of the state, they sell all their real estate and go to different states, they still have to report to California. And then at some point in the future, when they ultimately decide to sell and cash out, that's when they'd have to pay some of the California taxes. If they never sell, they always exchange until they pass on, and you get that step up in cost basis, and California never gets their fair share. So most of us just keep exchanging.
So I just want to make sure I understood you right, because you mentioned the pass on and the step up basis. So if you do play by the rules throughout your life, and when you pass, your estate goes on to your heirs would receive it at step up basis, and that clawback would be forgotten or
exactly,
dismissed.
just kind of completely goes away.
Okay.
And so for those who really aren't familiar with the step up, let's say you bought property years ago for $100,000 and today it's worth $1 million and you die. Your kids, let's say, would inherit that property, and the kids' cost basis is stepped up to the fair market value at the date of death. So their cost basis would step up and become $1 million for $1 million property. They could sell the next day for $1 million. Their cost basis would be $1 million. They'd pay zero capital gain, zero depreciation recapture, and zero Medicare surcharge.
Got it. I'm just trying to think here. So, the basics are you've got a property, it's got equity, you've had it for a while, you've depreciated it. You want to, maintain that asset base without paying the taxes. We contact you or a 1031 exchange or a qualified intermediary, enroll with them, get the documents drawn, the sale goes to the 1031 or the qualified intermediary. The clock starts ticking, 45 days to identify the property, 180 total to complete the purchase of the second property. Once the purchase of the second property has been received or has been transacted, are you then still on title to that property, or is there another recording then so that the property goes back to me or my entity?
Good question. If it's a regular forward exchange, we'll actually never take title to either property. So it's what they call direct deeding. And so on the purchase side, the seller would actually deed directly to the buyer. If it's a reverse exchange where we take title to the property, then as soon as the entire reverse exchange is wrapped up, then we transfer title to the client. So we would no longer be in the chain of title.
Gotcha. This has been very, very informative. Is there something that I'm not asking you or can you give some sort of is there any unique stories or examples you've run into recently, or I'm trying to think of?
We've certainly done a lot of interesting exchanges over the years. A lot of times investors focus on just real estate. They don't realize 1031 exchanges apply to what we call personal property or non-real estate. So we've done exchanges of aircraft, shipping, trucking, all sorts of machinery and equipment, livestock, baseball franchises, beer distribution rights. We actually did an exchange last year of a media right. So there's a lot of different things that can qualify. The probably the biggest thing that comes up a lot, and there's a lot of gray area out there and a lot of confusion out there, is what we call qualified use. So in order to qualify for the 1031 exchange, it has to be held for rental, investment, or business use. So like the meteorite, for example, that was held by this person as an investment, and it was always on display, and then somebody offered him $1 million for this meteorite. And at that point, it was held for investment, so it qualifies for 1031 exchange treatment. The question is, what are you going to exchange it for? Well, in his case, he exchanged it for other smaller, like a portfolio of meteorites. Things like that are possible. But the qualified use in the real estate context gets confusing. The best way to break it down is it's all about the intent for the investor. What's their intent with the property? So if they have the intent to hold for rental or hold for appreciation or investment or use it in some kind of a business, then it would qualify. If their intent is to buy real estate, rehab it, fix it up, and then flip it or sell it as quick as possible, it's really held for sale. It's not held for investment, so it wouldn't qualify for 1031 exchange treatment. So we have to look at the investor and ask the question, what's the intent? A lot of people get hung up on the length of time the property's held. They'll tell investors, well, you don't qualify for an exchange because you didn't hold title for at least 1 year. Well, the code, the regulations, rulings have absolutely no holding period required. All they do is require that you have the intent to hold. So if you held title for 1 day and you could prove you actually did have the intent to hold title, but something happened, medical issue, disaster, divorce, there's a business purpose why it was a 1 day holding period, you could qualify. You're just going to have a difficult time demonstrating that during audit. So that's really the issue. What's the intent? Those that are holding for rental investment qualify. Those that are holding for sale typically don't.
Got it. You bring up a question, the qualified or the intent, and also just on the sale, because I want to. You mentioned if I went through an exchange with you, and then literally 1 day later, divorce, whatever, medical happened, and I ended up selling it outside of the exchange. I'm assuming that's where this becomes an issue, is that you do the exchange from property 1 to property 2, and now after that, that becomes the suspect. Is that what am I following you right?
So if you were to, let's say that you bought it and just a few weeks later, something happened, a financial problem, a medical problem, what have you, and you have to move into the property. Your intent was to hold it as a rental, but something happened to where you had to live there as your primary residence. Well, that's not qualified use. So under audit, they'd probably try to disqualify that and say you didn't have the intent to hold it for rental, investment, or business use. If you can prove that you did have the intent, but something happened, some type of a business use, business purpose, whatever, that was really outside of your control, and that caused you to have this need to move into it, you'd still qualify. As an example, we had a client a while back that exchanged into a condo. So the replacement property was a condo, and his intent was clear in all the emails that he was going to buy it and hold it for rental purposes. Unfortunately, he didn't do his due diligence, so he closed, and then a couple weeks later, he finally read the CC&Rs and found out you can't rent it. So the business purpose is he had the intent, but he's not permitted to rent it. So he immediately sold, did another exchange into something that he could rent out.
Okay, so that just basically clears up the timeline, is what I'm understanding in that example. Let me ask you this. So let's say we do the successful exchange. Now we've got that gain from property 1 is now in property 2. We haven't paid any tax on that. If we end up selling property 2, can you explain how the tax code looks at that sale with respects to the gain that transferred from property 1 to property 2?
Sure. So when you sell property 1, of course, you defer your gain, you defer your depreciation, recapture, you effectively defer your cost basis into the new property. That property presumably goes up in value as well. And then at some point, if you sell the new property and just cash out and pay the tax, you're going to pay all of the taxes, all the accumulated gain, including the deferred gain, all your depreciation recapture, all of that will be triggered at that point. If you hit a recession and the property value drops considerably, if it drops low enough, it could, in theory, wipe out all of your gain and you pay no taxes. So it all depends on current market value and how much total gain or profit you're making on a cumulative basis.
Got it. So the sum there is that I guess if you're a property investor and you're using the strategy, it's kind of a lifelong strategy, I would assume, for most investors. They've committed to this, and this is the way they're retaining that I guess would be tax or not avoiding the tax, but deferring that tax for what when if they were to sell. Let me change gears just a second here. There's a I don't even know what it's called anymore. I would say it was called the Blueprint, the Republican tax plan blueprint that's been kind of floated out there, and the way Congress is working, I don't know what if anything will really get done on that. But I know one of the mentions in it is to do away with the 1031 exchange. Have you heard anything or know anything about that, or do you have any sense of if, how, what, or would that be just with, or would it affect what we're talking about? Would it? Can you speak to that a little bit?
Sure, it certainly could. Every 3 to 4 or 5 years, there's been some kind of a threat to 1031 exchanges. This is probably the most critical threat we've had in the past, or had in even the 34 years I've done it. Usually when there's a threat, there's one threat. One senator, one congressman has proposed something. In this case, there's probably 4 to 5 different proposals that have been circulating just over the last couple of years. And the proposals either propose to eliminate Section 1031 of the code or limit the amount of gain that you can defer through the actual 1031 exchange transaction. Those 4 or 5 proposals, for the most part, are kind of on the sidelines. The current write-up that's being looked at does not mention 1031 exchanges, but it's just a blueprint for starting negotiations, so it can very easily be added back. So I think today it's the most critical threat we've had to 1031 exchanges. What we tell people is now's the time to contact your local congressman, your local senator, and make sure they know how opposed to eliminating or limiting 1031 exchanges you are. What happens is a lot of the times it's an analyst in the back office who thinks, wow, if we just eliminate Section 1031, look at all this capital gain tax we're going to collect. And in reality, we've done surveys over the years, depending on the level of tax rates, usually 60 to 80% of investors will say, well, if 1031s go away, I'm just not going to sell my property. Then you don't have a realtor's commission, a title or escrow company, closing attorney, appraiser, lender, et cetera. All of these other ancillary services, they don't get their fees, they don't pay taxes, and it's a snowball effect. It just all of a sudden you get all these people who used to be collecting some decent revenue collect nothing and pay no tax. So when the analyst thinks it's a revenue raiser for the government, it's actually a revenue loser.
Right. No, I'm glad you pointed that out, because I think that is kind of the somebody's kind of looking at ways they can generate revenue, not understanding the how the system's currently set up and the benefit of it, and like you said, in the volume of transactions. If all of a sudden the transactions stop, I would think that would be horrible for all the parties involved in real estate. I mean, brokers, lenders, title exchanges, on and on and on, and I that's the piece that I've always kind of wondered. I say, how could they, how could they not, especially if you look at president being a real estate guy, you would think there would be some sort of a an understanding into that, or some sort of a deeper thought into that. So,
yep. It's the scary part. The industry trade groups, a whole bunch of industry trade groups have gotten together and they hired one of the big 4 accounting firms. And they asked the question essentially, if 1031 exchanges went away, what would the impact be? And they came back and said if Section 1031 was completely eliminated, GDP would drop by 0.8%. And that's huge. When you figure GDP is, bouncing, well, historically the last 10 years has bounced around, say, 1.5 to 2% maybe. A 0.8% drop is huge.
Wow.
And it would just show you that just eliminating 1031 exchanges, what the impact would be on the economy.
Got it. Got it. Bill, I'm looking down kind of my list of questions and stuff. Have we covered the 1031 exchange pretty thoroughly? Is there something that I didn't ask you that we should have?
I think we're probably good to go. I guess the last thing I could think of offhand is a lot of people get stuck on like kind, where they think if they sell a condo, they have to buy a condo, and that's not true. In the real estate context, you're selling real estate, you have to buy real estate. That's what like kind means. It's as simple as that. So things that you would not necessarily think about, but would be considered real estate, would also include air rights, water rights, mineral rights, certain types of oil and gas interests. All are considered to be real property. In some cases, easements or leases for cell towers, cell sites, for cell phones, billboards, things like that. So the definition of like kind is very broad in the real estate context.
Let me ask you just real quick. So if you do, let's say you have the investment condo, you sell that, and you found a houseboat down in the port there that you can rent out. Is that considered real estate to real estate, or have you crossed the line there?
Good question. My favorite answer is it depends.
Uh,
So in most cases, it's a boat. It's not going to qualify because it's not real estate. However, if the boat is permanently attached to the dirt, so it becomes part of the real estate. So sometimes you'll see the houseboats or larger boats, vessels, whatever, that are cemented in and become a permanent part of the dock. So now it's really, truly real estate. Then it would qualify. So in most cases, the answer is no, it won't work. But if they make it a permanent part of the real estate, it could qualify.
Gotcha. All right. So I'm going to ask you if you could give one piece of advice to someone looking to do a 1031 exchange, what would it be?
I think the biggest issue we see is lack of planning. So I would say the best advice would be to make sure you get your team together. So your real estate agent, your qualified intermediary, your closing agent, whether that be a closing attorney or escrow company, your tax advisor, your legal advisor, have your team ready to go. So when the transaction's there and ready, you can call the people, ask for advice. You don't have to put it together. You're all ready to go. And then plan ahead. So really sit down and plan out your 1031 exchange. And as you pointed out, look for replacement property right away or first. Kind of get your ducks lined up and in a row. Don't wing it, because when you wing it, that's when problems happen and exchanges fail.
Got it. You mentioned before we started the call, you have a guide you'd be willing to make available to the listeners. Can you tell a little bit about what's in that?
Sure. So it's a guide to 1031 exchanges. It's about 28 pages or so. It's an educational pamphlet or guidebook that kind of walks you through all of the basic 1031 exchange issues, even gets into some of the intermediate and advanced level stuff, but mostly it just walks through all the basics, explains just about everything we've talked about today, and be happy to make that available to the listeners.
Great. We'll have a link for listeners in the show notes. You can click on that and get that. And Bill, before we wrap up here, what's the best way for the listeners to get in touch with you and Exeter 1031 services?
You could go to the website, so it's exeter1031.com. So that's EXETER 1031.com. Or they can call the office directly at area code 619-239-3091. So that's 619-239-3091. And just ask for myself, or anybody who answers the phone can certainly help as well. So we're always available to answer questions or brainstorm.
Gotcha. And are you able to help people nationwide, or is there a territory limitation where you're able to do that?
We cover all 50 states. We do real estate and non-real estate. We're also one of the few exchange companies that will handle 1031 exchanges of foreign property. So if they have rental property in a foreign country, they want to sell that in exchange for other rental property also in a foreign country, we can take care of that. So geographic location does not present any limitation.
That's great. Well, Bill, thanks again for taking the time to talk today.
My pleasure.
I've enjoyed it, and I'm sure the listeners will find it valuable and useful. And if you're up for it, I look forward to doing this again sometime.
Yeah, be happy to. Absolutely.
All right.
Thanks for having us.
And for our listeners, if you like the show, share it. You can share the show with somebody you know. It's easy to do. Just go to the show there and click the share button, and you can share Bill's story. That's all we've got for you this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.